Stock market charts can seem like a foreign language to many people at first glance. They are filled with lines, bars, and patterns that can be confusing to beginners, making it seem overwhelming. But just like any language, with a little effort and practice, you can learn to understand them and use them effectively. Charts are a visual representation of a stock's price history, showing how the price has changed over time. They provide valuable insights into market sentiment and potential trading opportunities, helping you make better decisions. Learning to read charts is essential for any investor, whether you are a beginner or a seasoned professional, as it enhances your ability to analyze the market. Charts can help you identify trends, spot potential buying and selling opportunities, and manage your risk more effectively. Think of charts as a roadmap for navigating the stock market, guiding you through the ups and downs. Just as a roadmap helps you navigate unfamiliar roads, charts help you navigate the complexities of the market, providing clarity. They provide a visual representation of price movements, allowing you to identify patterns and trends that can indicate future movements. By understanding these patterns, you can make more informed investment decisions, increasing your chances of success in the market. The simplest type of stock chart is the line chart. It connects closing prices of a stock over a period of time. Line charts are easy to understand and provide a clear visual representation of a stock's price history. They are particularly useful for getting a quick overview of the stock's performance over a long period. For example, a line chart can show you whether a stock has been trending upwards, downwards, or sideways over the past year. However, line charts do not provide much information about the trading activity during each period. They only show the closing price, not the opening, high, or low prices. While line charts are a good starting point, they may not be sufficient for making informed trading decisions. For more detailed information, you need to look at other types of charts. Bar charts provide more information than line charts. Each bar on a bar chart represents the price range of a stock over a specific period. The bottom of the bar represents the lowest price traded during that period, and the top of the bar represents the highest price. The left tick on the bar typically represents the opening price, and the right tick represents the closing price. This additional information makes bar charts more useful for traders who need to see the full range of price movement during a given period. By analyzing the length of the bars and the position of the opening and closing prices, traders can gain insights into the buying and selling pressure during each period. Candlestick charts are similar to bar charts, but they provide even more visual information, making them a preferred tool for many traders and analysts. Like bar charts, candlestick charts show the opening, closing, high and low prices for a given period, but they do so in a way that is easier to interpret at a glance. However, they represent this information in a more visually appealing and informative way, allowing traders to quickly assess market conditions and make informed decisions. Each candlestick has a body that is either filled or hollow, depending on whether the closing price was higher or lower than the opening price, providing a quick visual cue about market sentiment. A filled or green candlestick indicates that the stock closed higher than it opened, suggesting bullish sentiment, while a hollow or red candlestick indicates that the stock closed lower than it opened, suggesting bearish sentiment. The wicks or shadows extending from the body of the candlestick represent the high and low prices for the period, giving a complete picture of the price range. Candlestick charts are particularly useful for identifying potential trading opportunities because they provide a clear visual representation of the balance between buying and selling pressure, helping traders to anticipate market movements and plan their strategies accordingly. Section 5. Identifying trends, the market's direction. One of the most important things to look for on a stock chart is the trend. A trend is the general direction in which a stock price is moving. There are three main types of trends: uptrends, downtrends, and sideways trends. An uptrend is characterized by a series of higher highs and higher lows. A downtrend is characterized by a series of lower highs and lower lows. A sideways trend, also known as a consolidation or a trading range, occurs when a stock price is fluctuating within a relatively narrow range. Identifying the trend is crucial because it helps you determine whether you should be buying or selling a stock. In an uptrend, you generally want to be buying the stock, while in a downtrend, you generally want to be selling or shorting the stock. Section 6. Support and resistance price barriers. Support and resistance levels are key concepts in technical analysis. Support is a price level where a stock tends to find buying interest and reverse its downward trend. Resistance is a price level where a stock tends to find selling pressure and reverse its upward trend. These levels are formed due to the psychology of traders and investors. When a stock approaches a support level, buyers are more likely to enter the market, preventing the price from falling further. Conversely, when a stock approaches a resistance level, sellers are more likely to enter the market, preventing the price from rising further. Understanding support and resistance levels can help you identify potential entry and exit points for your trades. Section 7. Breakouts and breakdowns. Signals for action. Breakouts and breakdowns occur when a stock price moves decisively above a resistance level or below a support level, respectively. A breakout is a bullish signal, suggesting that the price is likely to continue moving higher. A breakdown is a bearish signal, suggesting that the price is likely to continue moving lower. Traders often look for breakouts and breakdowns to confirm trends and identify potential trading opportunities. For example, if a stock breaks out above a resistance level that has been holding for a significant period, it could signal the start of a new uptrend. Conversely, if a stock breaks down below a support level, it could signal the start of a new downtrend. Section 8. Reversal patterns, shifting tides. Reversal patterns are chart formations that indicate a potential change in the direction of a trend. These patterns suggest that the current trend is losing momentum and that a reversal may be imminent. Some common reversal patterns include head and shoulders, double tops and bottoms, and triple tops and bottoms. For example, a head and shoulders pattern is a bearish reversal pattern that forms after an uptrend. It is characterized by three peaks, with the middle peak, the head being the highest, and the two outer peaks, the shoulders being roughly equal in height. Reversal patterns can be powerful tools for traders, but it is important to note that they are not always reliable. It is essential to confirm reversal signals with other technical indicators and to use proper risk management techniques. Section 9. Technical indicators, adding precision. Technical indicators are mathematical calculations based on a stock's price and volume data. They provide additional insights into the strength of a trend, momentum, and potential overbought or oversold conditions. Some commonly used technical indicators include moving averages, the relative strength index or RSI, and Bollinger Bands. Moving averages help smooth out price fluctuations and identify trends. The RSI measures the magnitude of recent price changes to evaluate overbought or oversold conditions. Bollinger Bands consist of a middle band and two outer bands that represent standard deviations from the middle band. Prices trading outside the outer bands may indicate overbought or oversold conditions. Technical indicators can be used in conjunction with chart patterns to confirm trends and identify potential trading opportunities. Section 10. Chart analysis in action. To illustrate how chart analysis can be used in real-life trading, let's consider an example. This will help us understand the practical application of the concepts we've discussed so far. Suppose you are analyzing the chart of a stock that has been in an uptrend. This means the stock's price has been consistently moving higher over a period of time. You notice that the price has recently pulled back to a support level and is forming a bullish reversal pattern. This pattern suggests that the stock might resume its upward movement. Furthermore, the RSI indicator is showing that the stock is oversold. An oversold condition often indicates that the stock is undervalued and may be due for a price increase. Based on this analysis, you might consider entering a long position with a stop-loss order placed below the support level. This helps to limit potential losses if the trade doesn't go as planned. If the price breaks above the resistance level, confirming the reversal, you might consider adding to your position or trailing your stop-loss order higher to lock in profits. This strategy can help maximize gains while managing risk. However, it is important to remember that chart analysis is not an exact science. Different traders might interpret the same chart in different ways. There is always a degree of subjectivity involved, and no trading strategy is foolproof. Market conditions can change rapidly, and unexpected events can impact stock prices. It is crucial to do your own research, practice risk management, and consider seeking advice from a qualified financial advisor before making any investment decisions. This approach can help you make more informed and confident trading choices.